Fed has delivered the long-anticipated hike, 25 basis points on Wednesday night. The FOMC declared that the inflation expectations have increased and that there is a forecast of 3 rate hikes in 2017. What impact will it have on global markets? Joining us to discuss this in detail is Seth Freeman. He's Chief Executive Officer at EM Capital Management. Good morning, Seth. It's always a pleasure to have you on the show, and more importantly, on a significant day like this. It's been the second rate hike in the last 1 year. What's your key takeaway from the Fed commentary in yesterday's session? And how do you think will the calendar of rate hikes going ahead into 2017 look like? Do you think it's a material reason to bother for emerging markets owing to the possibility of 3 rate hikes as opposed to 2?
Well, it changes perspectives in terms of how aggressive the Fed might be, plus data that the Fed might be looking at that's giving them the visibility to consider going from nominally 2 dots to 3 dots. Certainly, today's rise was anticipated, fully baked in, and I think the immediate market reaction really reflected the fact that Mrs. Yellen indicated there could be 3 increases. On the other hand, she was quite clear that there's plenty of uncertainty going forward and that they would continue to look at the data, and nothing was set in stone.
Right. Seth, what are the kind of larger risks that you see going ahead? Because if we talk about the aspiration for the GDP growth, if you don't have output growth per hour and output growth in terms of per labor metrics, how can you see that aspirational growth of 2% coming through? Does it all add up? Is the disaggregated data adding up and indicating a long-term objective of the GDP growth?
Well, in theory, with lower levels of unemployment, we should begin to see some inflation in wages, which has just creeped up a teeny bit. We still have large numbers of people who have stopped looking for work who are no longer counted. And we also have people who are being counted as employed, but have much more marginal positions than they had in the past. So although the unemployment rate is very low, the real impact of that increase in employment, or the improvement, is really not a very good headline number to rely upon. It's also very spotty in terms of regions of the country and industries. So whether we'll get real wage inflation, which is a big component, is one issue. It's uncertain if the expected increase in oil prices will really hold, but that could contribute to inflation. I think the main issue that we'll be facing is it's going to take a tremendous amount of government spending to implement these kinds of infrastructure projects that President-elect Trump is talking about, and that could also weigh heavily on the U.S.
It's interesting that you speak about government spending, Seth, because it's an interesting time. Going ahead into the new year, we might find some resistance possibly in terms of the Congress agreeing or not to a greater amount of stimulus. And in any case, is it of great relevance to talk about fiscal stimulus in an environment of near full employment?
Well, that's, economists are questioning the judgment of these kinds of stimulus programs when we start to become more stabilized, that this is the kind of thing that should have been done 3 or 4 years ago. But that said, like I said, there's still plenty of relatively, you could say, underemployed Americans. And these kinds of projects, do create a lot of jobs. They create a lot of jobs in lower skilled areas, which are wanting for jobs. But the data or the projected data of the impact of the Trump policies is conflicting in terms of the inflationary aspect of it and the deficit increase from it, plus coupled with some tax cuts that the Trump administration future administration is talking about. So there is plenty of uncertainty going forward. Higher interest rates will affect consumers. We're already seeing an increase in mortgage rates by about 1%. So mortgage rates have been hanging around 3.5%. So a 1% increase is more than a third. This makes mortgage payments unaffordable for a good sector of our economy. And it just puts pressure on the entire housing market.
Seth, how much of a probability do you assign to the yield going up to 3%? How soon can we get that? Is that a real possibility after this move that we've seen yesterday? And do you feel that liquidity will be impaired going ahead into 2017?
Well, we have the benefit of being able to print more money, so I don't think we're going to have a liquidity problem per se. But I think there's a real chance that interest rates, the 10-year treasuries have already gone up, and those are also used as the benchmark for mortgages. So it has a big systemic effect. So I don't think liquidity really will be the issue. In fact, if what Trump is talking about, rolling back Dodd-Frank, the Volcker rule, and so forth, banks may be able to lend more, and it might be easier to borrow, and that's going to generate the needed liquidity.
Speak to us about the dollar index, Seth, because that has only strengthened. A higher dollar would typically tend to suppress inflation. Is that in disjunction with the long-term 2% target?
Well, I think we will see a continuing gains in the dollar on a relative basis. We still have very slow growth in Europe. We have a lot of uncertainty in Europe, and those countries, although they might be changing their own formula for QE, they're still trying to promote growth. So it's going to have an impact, frankly, on emerging markets, only because our currency is going to continue to strengthen. And as I've said previously, for investors, portfolio investors, our reporting our NAVs are in U.S. dollars. So if our foreign currency holdings go down, it impacts our returns.
Right. Seth, this 25 basis points was mostly factored in. So in that, there's no major surprise on the downside. But when do you think the real impact of capital flight starts returning to emerging markets? We are seeing the yield gap closing between at least India and the US. How much more time do you think that the real risk of capital flight starts emerging? We've already started to see some signs of it. Is it likely to aggravate for EMs going ahead from here on? And what do you think about currency depreciation here in light of the yuan sliding? Do you think that will put competitive pressure on emerging market peers to continue devaluing?
I don't know that the RMB sliding is necessarily going to put competition by other countries to devalue. I think it's really going to be much more based on, country-specific macroeconomics, and in particular policy, fiscal policy, and other kinds of trade policies. So I think actually there's going to be, once the Trump administration is in place, I'm actually thinking that the relationship between the U.S. and India relative to trade will be positive. That might help support the rupee somewhat. But in general, there will be pressure, and this will create some, you call it capital flight. I would call it redemptions, and just bring money back home. However, that said, so much money now is invested using index-based strategies. So that creates some stability because India's percentage, each country's percentage in a global index has to be maintained. So if more money does continue to go into the stock market, then there'll be a residual benefit to certain the bigger emerging markets.